In a hysterical market in which everyone is always chasing the same old big tech companies, convinced that they are making the deal of the century, there are shares that have very high growth potential but that many ignore because they are far from the spotlight of big investors. Would you like to know the top 5 stocks you should add to your portfolio before you regret it bitterly? Stay tuned to the video until the end and you will discover all the real and concrete reasons why these companies can only grow in the future and are already doing so. But before I start describing these 5 actions to you, remember to subscribe to the channel and activate the bell so you don't miss the new videos. Thank you. Now let's not waste any more time and start with the top 5 stocks you should add to your portfolio before you regret it. Number 1. Alaska Air Group Inc. ALC. Alaska Air Group is a holding company engaged in the provision of air transportation services. The company is headquartered in Seattle, Washington, and currently employs 22 full-time employees and is capitalized at $509 billion. Alaska Air Group operates 2 major airlines, Alaska Airlines and Horizon Air, offering an extensive route network covering multiple destinations in the United States, Mexico, Canada, and other international locations. With a modern and efficient fleet, the company is committed to providing a superior travel experience characterized by comfort, reliability, and first-class customer service. Alaska Air Group's strategy focuses on targeted route expansion, operational flexibility, and the adoption of cutting-edge technologies to improve operational efficiency. The company is also known for its commitment to environmental sustainability, constantly seeking innovative ways to reduce the environmental impact of its operations. As a key player in the aviation industry, Alaska Air Group continues to thrive through prudent management, strategic vision, and an unwavering commitment to excellence in the aviation industry. In our analysis tool, Alaska Air obtains really interesting scores, namely an insight of 316 and a 405 for analysts, demonstrating the company's solidity and growth forecasts. The stock is currently trading at $39.17. Since the beginning of the year, it has lost over 26%, but today it has already reduced this loss to 5%. Also in November, it announced a partnership with Condor Airlines that will allow Alaska passengers to fly to Europe. In the last month alone, the stock has gained over 25% and seems to have started again to reach its first objective set at $45 and then continue towards its potential target price, which according to our analyses should be $73.50. Namely with a profit margin of 85% compared to today. In our opinion, it is a stock that may be worth investing in, especially at these prices. Number 2. Materion Corp. MTRN. Materion is engaged in the production of engineered materials used in a variety of electrical, electronic, thermal, and structural applications. The company is headquartered in Mayfield Heights, Ohio, and currently employs 3,723 full-time employees and is capitalized at $2.38 billion. Materion is a leader in the production of advanced materials, particularly beryllium, high-performance alloys, diamond coatings, ceramics, and inorganic chemical materials. These materials are used in a variety of applications, including electronic applications such as the production of transistors, chips, and other electronic devices, aerospace applications such as the construction of airplanes, missiles, and other space vehicles, defense applications such as the construction of weapons and other military systems, medical applications such as the construction of medical equipment and other medical devices. Finally, energy applications such as the construction of gas turbines, nuclear reactors, and other energy plants. Materion is investing in new technologies to improve its capabilities and broaden its product range. For example, the company is developing new processes for the production of beryllium and high-performance alloys, as well as new diamond coatings for abrasive applications. The stock has excellent scores in our analysis tool, which confirm its financial solidity, and the analysts' forecasts in fact obtain 3.76 from Insight and 4.1 from analysts. The stock is currently trading at $115.29. In the last month, it has gained over 7% and does not intend to slow down its run towards its historic highs now within reach at $117. According to our analyses, the stock has a potential target price of $145 or a 25% profit margin from current values, but it could only be a stage towards even higher levels. The stock today might seem close to its highs and therefore an unknown, but in our opinion there are no particular reasons why its growth should reverse course given its continuously growing sector. Number 3. Canadian Pacific Kansas City Ltd. CP. Canadian Pacific Kansas City provides rail freight services. The company is headquartered in Calgary, Alberta, and currently employs 17,608 full-time employees and is capitalized at $67.45 billion. Canadian Pacific operates approximately 20,000 miles of rail and provides North American customers with unmatched rail service and network coverage of key markets across the continent. The company offers a suite of freight services, logistics solutions, and supply chain expertise, Furthermore, transports ethanol from production areas in the Midwestern United States to consumer markets in the Northeastern United States and Canada. CP serves various markets, including Canadian wheat, United States wheat, mass, intermodal, automotive sector, forestry and industrial products, transfer and energy, chemicals and plastics. Its wholly owned subsidiary is the Canadian Pacific Railway Company. The company is poised to see improved growth as customers realize the value proposition of the CP-KCS combined rail system, and the company benefits from revenue synergies from the merger. Additionally, the recovery in the auto and potash markets, the bottom of the housing market, and market share gains should help the company's growth. The margin outlook is also good as the company realizes cost synergy from the integration of CP and KCS. Furthermore, continued productivity savings through optimal resource utilization and disciplined execution to optimize service and control costs should aid the company in margin expansion in the medium to long term. The stock is currently trading at a discount to historical levels, and considering CP's favorable growth outlook, we believe it is a good buy. In our analysis tool, CP obtains truly excellent scores, namely an insight of 3.83 and a 3.94 for analysts, proving the company's truly excellent prospects. Today, the stock is trading at $74.83 and has remained stable since the beginning of the year after falling by more than 7%. In the last week alone, the stock has gained over 7% and seems to have taken the right direction towards its potential target price, which according to our analyses is at $100, i.e. with a profit margin of over 30%. Before continuing with the fourth company, we want to ask you a question. What do you expect from the stock markets in 2024? Do you think the fight against inflation will finally bear fruit? Let us know what you think. It's very important to us. Thank you. Number 4, Diamondback Energy Inc. FANG. Diamondback Energy is an independent oil and natural gas company engaged in the acquisition, development, exploration, and exploitation of onshore unconventional oil and natural gas reserves. The company is headquartered in Midland, Texas, and currently employs 972 full-time employees and is capitalized at $27.61 billion. FANG operates through its upstream segment, engaged in the acquisition, development, exploration, and exploitation of onshore unconventional oil and natural gas reserves, primarily in the Permian Basin of West Texas. Midstream operations focus on owning, operating, developing, and acquiring midstream infrastructure assets in the Midland and Delaware basins of the Permian Basin. The company has prime assets in the Permian Basin, which delivered strong results in the third quarter. For this reason, its name is bound to spark speculation amid the recent wave of activity in the energy sector. With a pristine balance sheet and a strong capital return policy, we see further upside for the shares. Production rose sharply, helped by asset optimization activity, to 266 million per day from 224 million per day last year. Oil production will increase by 18% this year. In a world of high inflation, it's interesting to note that Diamondback is actually reducing operating expenses. Cash operating costs decreased $15 in the quarter to $10.51, down from $11.97 last year. This contributes to industry-leading cash margins and solid cash flow despite a slight decline in oil prices. FANG delivered strong production, allowing it to raise its forecast, and production will increase further in the fourth quarter, with cash flow hitting $2.9 billion. In our analysis tool, FANG obtains really high scores, namely an insight of 354 and a 397 for analysts, proving the quality and strength of the company. Today, the stock is trading at $154.28 despite a 5% decline in the last month. Since the beginning of the year, the stock has gained 17%. According to our analyses, its potential target price is $250 with a profit margin of over 60%. At this point, if you liked the video, we ask you to subscribe to the channel, put a like, and activate the bell to stay updated on new videos like this. Thank you for your support. We finally arrived at the last company that rounds out our 5 stocks you should add to your portfolio before you regret it. You will discover that the US market hides many realities, with truly incredible growth potential, but which not everyone knows or wants you to know. Good vision. Number 5, Sterling Infrastructure Inc., STRL. Sterling Infrastructure is committed to providing building solutions. The company is headquartered in the Woodlands, Texas, and currently employs 200 full-time employees and is capitalized at $2 billion. Sterling specializes in 3 segments: electronic infrastructure, transportation, and building solutions in the United States, primarily in the southern, northeast, and mid-Atlantic United States, the Rocky Mountain states, and Hawaii. Electronic infrastructure solutions projects include large-scale site development systems and services for data centers, e-commerce distribution centers, warehousing, transportation, energy, and more. Transportation solutions includes infrastructure and rehabilitation projects for highways, roads, bridges, airports, ports, light rail and storm drainage systems. Building solutions projects include residential and commercial concrete foundations for single-family and multifamily homes, parking structures, elevated slabs, and other concrete work. The building solutions segment includes residential and commercial activities. The company is seeing increased demand as a result of increased data center requirements, reshoring of U.S. manufacturing operations, aging infrastructure, and federal infrastructure funding. Furthermore, the residential market is also near the bottom, and any recovery in demand within the residential market is expected to contribute to revenue growth. On the margin front, the company is expected to benefit from high-margin projects in its portfolio, improving execution and reducing supply chain challenges. The valuation also seems reasonable due to the stock price correction. Over the past year, the company has focused on being highly selective in the bidding process and selecting only high-margin projects. This led to a 200 basis point year-on-year increase in combined order book margin to 14.9%. The company continues to focus on high-margin projects, which should help margins. In our analysis tool, Sterling obtains very high scores, namely an insight of 419 and a 414 for analysts, proving the company's enormous potential and financial solidity. Today, the stock is trading at $64.86, a decline of 16% in the last month represents a correction to take advantage of. In fact, since the beginning of the year, the stock has gained over 90%. According to our analyses, the stock can still continue its growth up to its potential target price of $95 with a profit margin of over 40%. These were the top 5 stocks you should add to your portfolio before you regret it. These companies appear far from the spotlight of current trends such as AI, semiconductors, and high-tech companies, but they are companies with solid balance sheets and future projects and prospects for certain growth. In our opinion, they are companies in which to invest without problems and increase one's positions at each retracement because they are destined to grow in the coming years without a shadow of a doubt. Finally, we remind you that we are not financial advisors and that these are not invitations to purchase, but are simply our personal analyses, the result of our experience on the U.S. stock market. We always invite you to delve deeper and verify our analyses before investing your money, because you must be aware of your investments and not risk losing them just because of rumors you hear online.
See you soon, investor!